Imagine this. You walk into a bank to apply for a mortgage. You did everything right. 750 credit score, 20% down payment saved, stable job making $75,000 a year, not a single missed payment in your entire financial history. The loan officer smiles at you, types a few numbers into the computer, and 30 minutes later you're approved for a $300,000 mortgage at 5.75% interest. You played by the rules. You did everything they told you to do. You signed the documents feeling proud because you earned this. What you don't know is this: the person who sat in that same chair yesterday, with the exact same credit score, the exact same down payment, the exact same income, and the exact same loan amount, got approved at 5.1%. The only difference? He was white and you are black. That half-point difference feels small until you do the math. Over 30 years, that means $28,000 in extra interest you'll pay on the exact same house. $28,000, the penalty for having the wrong skin color. And the most infuriating part? This is completely legal. I'm Wyatt and I spend way too much time digging up systemic financial traps that keep entire communities poor while appearing fair. If you've ever felt like you were playing a rigged game, or if you've been told that racial discrimination in lending no longer exists because of laws against it, hit that subscribe button and give the video a thumbs up if this helps. What I'm about to show you will make you question everything you thought you knew about the American financial system. Most people think credit discrimination ended at some point in the 1960s with the Fair Housing Act. They think we solved this problem, that banks can no longer charge different rates based on race, that the system is now colorblind. And technically they're right. Openly discriminating based on race in lending is illegal. But what's actually happening is far more sophisticated than a loan officer looking at skin color and checking a different box. Discrimination has been coded into algorithms, hidden in zip codes, embedded in property appraisals, and wrapped in layers of deniability that make it almost impossible to prove in any individual case. Let me show you this with real numbers from real studies, because the data on this is absolutely damning. A 2023 report from the National Association of Real Estate Brokers found that black borrowers with credit scores over 700 paid on average 0.5 percentage points more in mortgage interest than white borrowers with the same score, half a percentage point. That's the racism tax. And it applies regardless of income level, down payment size, or how perfect your financial profile looks on paper. But it gets worse. A study from UC Berkeley analyzing 31 million mortgage applications between 2018 and 2021 found that black borrowers were 80% more likely to be denied a conventional mortgage compared to white applicants with the same financial profile. 80%. Same credit score, same income, same debt-to-income ratio. But if you're black, your application is 80% more likely to be denied. Let me introduce you to Kesha. She's 35, works as a nurse making $68,000 a year, has a 730 credit score, and has been saving for a house for 6 years. She has $40,000 saved for a 20% down payment on a $200,000 house in her city. She walks into the bank confidently because her finances are flawless. No credit card debt, no student loans, no car payment, nothing. She did everything the financial advice books told her to do. The bank approves her for the mortgage, but at 6.25% interest. She's excited to be approved and doesn't notice that her co-worker Sarah, who has a 720 credit score, 10 points lower than Kesha, got approved last month for the exact same loan amount at 5.6%. Same bank, same loan program, same down payment percentage, but Sarah is white and got a 65% lower rate. Think about what this means in real dollars over the life of the loan, where the real theft becomes visible. Over 30 years on a $200,000 mortgage, Kesha will pay $246,000 in interest at 6.25%. Sarah will pay $212,000 in interest at 5.6%. That means Kesha is paying $34,000 more for the exact same house. And this assumes neither refinances or moves. $34,000. This isn't a rounding error. This isn't a small difference you can shrug off. This is life-changing money. This is a college fund for a child. This is seed money for a business. This is early retirement. This is generational wealth extracted from black families and transferred to bank profits. You might be thinking right now, maybe there was some other factor in Kesha's application that justified the higher rate. Maybe there's something else that explains the difference. And that's exactly what the banks want you to think. That's the genius of modern discrimination. There's always a technical explanation that sounds perfectly reasonable until you look at the pattern across millions of loans and realize the technical explanations always leave the same group disadvantaged. The way this actually works is through a combination of factors that together create a system that produces racial discrimination while remaining legally defensible. Banks use automated underwriting systems that take into account things like zip code, property appraisal value, and neighborhood risk scores. On the surface, these look race neutral, they're just analyzing data, right? But when black neighborhoods are systematically appraised lower than comparable white neighborhoods, when zip codes with higher black populations are flagged as higher risk, when the algorithm is trained on historical data that includes decades of racist lending practices, the output is discrimination by statistical degree. Property appraisals are one of the clearest examples of this, and the research on appraisal bias is genuinely shocking. A 2021 study from Freddie Mac found that homes in black neighborhoods are appraised on average 23% lower than similar homes in white neighborhoods. 23%. Same square footage, same number of bedrooms, same condition, same local amenities, but because the neighborhood is predominantly black, the appraisal comes in almost a quarter lower. Think about what this does to Kesha's loan. If her house gets appraised 20% lower than a comparable home in a white neighborhood, her loan-to-value ratio looks higher. This makes her appear like a riskier borrower. This justifies applying a higher interest rate. Racism gets laundered through the appraisal, and the bank can justify the higher rate based on the lower property value without ever mentioning race. There's also something called discretionary pricing, which gives loan officers the ability to adjust rates within certain ranges based on the borrower's appraisal. Studies have consistently shown that this discretion is used to charge black borrowers more. A 2018 report from the Consumer Financial Protection Bureau found that black and Latino borrowers were forced to pay higher add-on fees on auto loans compared to white borrowers with similar credit profiles. And the difference was over $250 per loan on average. This isn't just auto loans. The same dynamic applies to mortgages, personal loans, small business loans, everything. Let me show you what this looks like over a lifetime, because the compound effect is truly horrifying. Kesha buys her house at age 35 with that 6.25% mortgage. Over 30 years she will pay $246,000 in interest. Meanwhile, Sarah buys her house at the same age with the 5.6% rate and pays $212,000 in interest. That's the $34,000 difference on the mortgage alone. But it doesn't stop there. Because Kesha's house got a lower appraisal, she has less equity to borrow against if she needs a home equity loan. When she goes to refinance 5 years later, the lower appraisal value limits her options. When she eventually sells the house, she gets less money because homes in black neighborhoods appreciate more slowly than homes in white neighborhoods, even when all other variables are controlled for. A 2021 study from the Brookings Institution found that homes in majority black neighborhoods are worth 23% less than homes in majority white neighborhoods, even after controlling for crime rates, walkability, school quality, and all the other factors supposedly determining home values. So over her lifetime, Kesha ends up with significantly less wealth than Sarah, despite having a better starting credit profile, saving more diligently, and doing everything right. The system extracted that wealth from her through higher interest rates, lower appraisals, and slower appreciation. And if you ask the bank why any individual transaction happened this way, they'll have a perfectly reasonable sounding technical explanation. The discrimination isn't visible in any single case, but it becomes obvious in aggregate. The historical context makes this even more infuriating, because this isn't just something that happened by accident. The racial wealth gap we see today is the direct result of explicit government policy. From the 1930s to the 1960s, the Federal Housing Administration literally had a redlining policy. They drew red lines around black neighborhoods on maps and refused to guarantee mortgages in those areas. Banks followed the government's lead and didn't lend there, which meant black families were systematically excluded from homeownership during the exact period when the white middle class was building wealth through government-subsidized mortgages. This isn't ancient history. We're talking about 1968, just 58 years ago. There are still people alive today who are openly denied mortgages because of their race. Their children and grandchildren are still dealing with the wealth gap this created. In America, the median white family has 8 times the wealth of the median black family. And the primary driver of this gap is home ownership rates and home equity. White home ownership rate is around 72%. Black home ownership rate is around 44%. And this gap exists after decades of explicit discrimination followed by decades of implicit discrimination. When politicians and banks say we solved the discrimination problem, they are technically correct that overt discrimination is now illegal. But they are completely wrong that the problem has been solved. Discrimination just got more sophisticated. Instead of saying we don't lend to black people, the system now says we don't lend in these neighborhoods with these risk characteristics. And those neighborhoods remain disproportionately black because of the residential segregation we created through redlining. Instead of saying we charge black borrowers higher rates, the system now says we use this proprietary algorithm to set rates. And because the algorithm is trained on historical data that includes decades of racist practices, it produces racial disparities. Let me tell you what happened to the real Kesha, the real person I know who lived through this. She took that 6.25% mortgage and was happy about it for about 6 months until she mentioned it at work and her white coworker told her what rate she got. Kesha started researching, looking at studies, and realized she wasn't imagining things. The system really was charging her more. So she did something most people don't do. She fought back. After aggressively shopping around and building a paper trail, she refinanced with a different lender. She got her rate down to 5.8%, still higher than what Sarah was paying, but better than where she started. That refinance saved her about $60 a month, $720 a year, which over the life of the loan is about $20,000. But the refinance process cost her $2,000 in fees and took 3 months of her time dealing with paperwork, phone calls, and negotiations. She had to take time off work for the appraisal and closing. She had to fight for what Sarah got automatically. This is what systemic discrimination looks like. You're not told no outright, but you have to work twice as hard and pay more to achieve the same outcome. 3 years later, Kesha is doing okay. Her mortgage is manageable. She's building equity, but she's still behind Sarah because Sarah's house in a white neighborhood appreciated 12% while Kesha's house in a black neighborhood appreciated 6%. Same city, same housing market, same time period. But Sarah's house gained $24,000 in value while Kesha's gained $12,000. Another $12,000 wealth gap opened up solely because of where their houses were located and who lived in those neighborhoods, through no fault of Kesha's. The most infuriating part of this entire system is how it hides behind technical complexity and makes you feel crazy for suggesting race is a factor. When you point out that black borrowers are paying higher rates, the response is always that it's because of credit scores or debt-to-income ratios or property values or risk models. But when you control for all those factors and the disparity still exists, when there are studies that analyze millions of loans and find consistent patterns of racial discrimination even after controlling for every possible variable, at some point you have to acknowledge what's really happening.